Record on. Okay, everybody. Thank you, everybody, for coming. It's nice to see some lovely faces. My name is Chrissy Dunlop, and I'm a carer advisor for Herefordshire CarerLinks. This morning's session, we are going to do a workshop on finances, and we're very fortunate to have with us Steph from Citizens Advice Bureau, Richard Green from Just Wills, and Suzanne Farmer from Herefordshire Council Financial Assessment Team. So this is one of a few workshops that we're doing throughout this week in Carers Week. And we're following the Outcome Star, which is the Carers Star, a tool that we use to plot carers' journeys. So hopefully you'll gain some relevant information from today's session. For anybody that isn't available to watch it now, it is going on the website, so you will be able to tap into it at a later date if there's something that you can't remember or you think, oh, didn't quite make a note of that. You'll be able to access it on the website. Okay, I'm going to hand over now to Steph from Citizens Advice Bureau. The floor is yours, Steph.
Thank you. Good morning, everyone. So I'm Steph. I work at Citizens Advice. I currently cover Worcestershire, but it's always subject to change and funding. So I haven't included my contact email details on the presentation, but there are contact details for Herefordshire office on there. The presentation is also designed in a way that it can be used as a handout. So there's a lot of information on there. It might be slightly death by PowerPoint, but that was kind of the purpose behind it. So I will skim over some of the information that's better accessed as and when you need it, if that makes sense. So I will try and share my screen and hopefully it'll all go well. Right. Can you all see that? Excellent. Okay. Citizens Advice is, hang on, I've got a screen overlay issue. So Citizens Advice provides independent, impartial, confidential and non-judgmental advice. It's free of charge, and we provide advice on a wide range of subjects. At a local level, there's the help to claim for universal credits, benefit and debt advice, Macmillan benefit advisors, housing and court desk advice, and pension wise. Those are the services that we provide directly. There are also, so Citizens Advice also does a lot of campaigning, and we raise national issues such as campaigning to keep the £20 uplift on universal credit. So they're quite important issues, and if we feel that something is an issue that may be experienced by other people, then we'll speak to the client and ask them permission whether we can share their story so that things can be changed at a national or local level. Okay, so with regards to entitlement, people can absolutely look at their own entitlement. But it comes with a sort of caveat warning in the sense that benefits rules around carers and disabled persons can be quite complex. So it can be good to get additional advice if you're unclear about anything, or if you just want to make sure that what you found is correct, that kind of thing. Typically speaking, there are two benefits checkers that I find very good. That's Turn to Us and Entitled To. And they can also give you information about income maximisation. So things around things like free healthcare, grants that can be accessed, energy supply, discounts, benefits, grants, etc. So they're quite useful. Right, sorry, bear with me. I'm going to minimise the video so I can see my full screen. Okay. So typically speaking, in carer and disability benefits, we talk about qualifying benefits. So that's where the person that's being cared for needs to be in receipt of a certain number of different benefits. So things like disability living allowance, the care component, either the highest or middle rate, PIP or personal independence payment, daily living component, either rate, armed forces independent payment or attendance allowance. There are quite complex rules around constant attendance allowance. So it's worth, again, getting a bit of further advice. Now, carers are, first of all, sort of typical carer benefits, and it's the one that probably a fair amount of people will know something about. It's worth knowing that while carers allowance doesn't take into account other income or savings, it is actually counted as income for means tested benefits, and so it can impact on the benefits for the person being cared for and the carer. The person who's applying for carers allowance needs to be age 16 or above, be present and habitually living in the UK, and not be subject to immigration control. That last one does have some exceptions. So again, if you've got somebody in those circumstances, it's worth getting a bit of further advice. They must be caring for someone who's in receipt of the qualifying benefits that we've just talked about. They must be providing regular and substantial unpaid care for at least 35 hours a week, although there may be some exceptions for older people. They don't have to be living together or be related, but can be. And this is one of the rules that changes in amongst the different carer benefits. It's worth paying attention to. The carer cannot be in gainful employment. Now that means that they can't be earning more than £128 per week or be in full-time education. And only one carer can claim benefits for one person needing care. So at the moment, the rates are £67.60 per week. But like I said, there are some overlapping benefits. So if, for example, somebody is receiving job seekers allowance or universal credit and carers allowance, actually those two benefits kind of merge, and you won't receive the full amount of both on top of each other, if that makes sense. So on each of my pages about benefits, I'll have further details about how you can claim. So the claiming process, in effect, how to contact them, and their address. Now these things can change, so it's worth double checking, but at the time of writing this was correct. And citizens' advice can help not only with finding out about entitlement, but helping to actually make the claim. So for people who might be a little bit less confident about the claim process or just want a bit more details, we can do sort of pretty much everything from helping to do the claim form with you to checking a claim form that you've drafted to see if anything else needs to be included, or advising about the claim process or entitlement, or even appealing or asking for reconsideration on a decision. Carers credit. Typically somebody might not qualify for carers allowance, but might still be providing 20+ hours of care per week. It's a national insurance credit that pays your national insurance contributions, helping towards your state pension, which takes into account your national insurance contributions. So where somebody has been caring or is caring for a significant period of time and perhaps might not be able to work during that period of time, it's really quite important because it can help boost the state pension amount. They need to be over 16 but must be under state pension age, and the person that you care for must be on a qualifying benefit, as we talked about before. There are certain circumstances where you don't need to apply for carers credit. So for example, you already get carers allowance, you get a child benefit for a child under the age of 12 because you'll automatically get those credits, or you're a foster carer where you might apply for national insurance credits instead. Again, here are details about how to make those claims. So carer premiums and elements in other benefits. So these are not benefit claims as such, they're sort of bolt-ons to existing benefits that you might already be claiming. So if you're claiming a means tested benefit, that's one that takes into account your income, you might get an additional amount in your claim if you make a claim for carers allowance, even if carers allowance is not actually paid because of other benefit rules. If you claim income support, income-based job seekers allowance, housing benefit, or income-related employment and support allowance, or pension credit, you might get a carer premium. Now that's £37.70 per week at the moment. If you claim universal credit, you might get the carer element, which is £163.73 per month. Now, normally speaking, these should be applied automatically, but in the cases where they're not, you should speak to the benefit that it's a bolt-on to. So for example, if you're claiming universal credit, then you should speak to the universal credit team. There are also disability premiums applicable to the disabled person's benefit, or in the case of a parent or primary carer with a disabled child, to the parent's benefit. These are linked to their applicable benefits and not carer's allowance, however, may be affected by carer's allowance. And these are more details about how to access those benefit departments. Now, details about the premiums should actually be on your letters. However, in my experience, they're not always very clearly detailed. So if you're not sure, you can ask Citizens Advice for further details, or you can ring up the benefit provider themselves and ask them. Council tax. Now, carers typically are referred to as unpaid carers. Care workers are people who are paid to provide care. In some cases where the carer is living with the person being cared for and no one else, there may be an applicable single person's discount of 25%. It needs to be the carer's sole and main residence, and the unpaid living carer must provide care for at least 35 hours a week on average, and this is where it differs from carer's allowance, must not be the partner of the person who's being cared for, or the child's parent if the person being cared for is under 18, and the person being cared for must normally get a qualifying benefit. Now, this is a slightly funny one, and I don't know whether Suzanne might be able to explain that one a little bit better. I would recommend that you go straight to Herefordshire Council to ask for further details. But if somebody is employed to provide support or care to another person at the same address for a minimum of 24 hours a week, and they're employed to do so by a charity, local council, the government, or employed by the person being cared for, having been introduced by the local council, charity, or the government, and earn no more than £44 a week before deductions. So that's where really there needs to be a further discussion. But if that applies to somebody that you know or yourself, then it's worth getting further details. Disabled persons council tax, council exemptions. So this is because, typically speaking, or from what I've seen, there isn't as such a carer discount of it, applicable, but the person being cared for might be eligible for some discounts or exemptions. So in the case of the disabled person reduction, it's very, very specific. It's where the property has been specially adapted, and those adaptations are specifically mentioned on the council website, and that's adaptations to meet the needs of the person with disability. Where the patient is in a care home or hospital, then the property can be discounted or exempt. That depends on whether the property is occupied solely by the person with disabilities or health conditions, or whether it's occupied by themselves and their carer. So where the property is left unoccupied, then the property might be exempt from council tax. If the person who needs care moves into a hospital, nursing home, or care home on a permanent basis, and you as the carer are the only person over 18 remaining in the property, you might be able to apply for that 25% discount. In the case of severe mental impairment, so typically that might be people with dementia or cognitive difficulties, it must be certificated by a registered medical practitioner, and the person with disabilities must be in receipt of qualifying benefits. Now, this list is a little bit different to the list that I displayed at the beginning, so it's worth having a look at the Herefordshire Council Herefordshire Council website, because it includes some means-tested benefits. If the only person living in the property is the one with the severe mental impairment, then the property might be exempt from council tax altogether. There's details of how to access those discounts and exemptions. There is a form for each one, and those forms are on the website. So talking about energy, with vulnerable people, that can apply either to the carer or to the person being cared for. They can apply to be put on the priority services register with their supplier, and that gives you all sorts of additional help. Things like being reconnected quicker, or having alternative supplies or provisions being provided. It really is worth doing for anyone who might be applicable to that. As with anyone else, checking tariff options and making sure that you're receiving the tariff that's cheapest for you is worth doing. Dual fuel by the same provider can be cheaper. Direct debit payments can be cheaper as well and have discount options. There can be advice around improving energy efficiency, and there are some grants that might be available depending on criteria. So Keep Herefordshire Warm is a scheme that provides that locally, and they provide advice as well as access to grants. Supply regular meter readings and checking your bill is really worth doing, making sure that you're not being overcharged. And billing options, online is usually cheapest, although that can be more difficult for people to manage, particularly if people are vulnerable. Now, energy benefits, and that does come under sort of benefits advice. You've got the Warm Homes discount, which provides £140 off your electricity bill for the winter of 21 to 22, and that's paid directly to your energy supplier and applied to your bill. With all of these, there are qualifying factors. So somebody who gets guarantee credit element of the pension credit will be in the core group, but also people who are on low income and meet the energy suppliers criteria for the scheme might qualify for that. Now, energy suppliers have slightly different criteria, so you do need to go directly to the energy supplier for that information. Cold weather payments, this is where if the temperature in your area or average temperature is recorded as a forecast to be 0 degrees Celsius or below for 7 consecutive days, you can get £25 for each 7-day period of very cold weather between 1st of November and 31st of March. And that again is tied into claiming certain benefits or support for mortgage interest. Winter fuel payments, that applies to people who were born on or before the 5th of October 1954, and they could receive between £100 and £300 to help pay for their energy bills, or their heating specifically. You don't typically need to apply, but if you get any of the if you don't get benefits or state pension, or if you only get housing benefit, council tax reduction, child benefit or universal credit, then you do need to make a claim by phone. Now, some benefits do entitle you to what's called fringe benefits or additional benefits that you can get as a result of claiming a particular benefit. Typically, are free license if you as the license holder are 75 or older and you or your partner living at the same address receiving pension credit. And that's a relatively new scheme, so it came into play last year, so it's worth checking that either yourself or somebody that you care for are actually receiving that free TV license. Free or reduced cost healthcare. This is quite a minefield in some respects. There are qualifying benefits, but it's also dependent on income and age. So for universal credit, for example, it's depending on income. So some people who get universal credit might not be entitled to free healthcare, and some might be. It does depend on the income. With regards to disabilities, there are a number of travel discounts, so such as a disabled person's bus pass, which gives you free travel, a disabled person's rail card that gives you 30% discount on fares, a blue badge. Now, if you get a qualifying benefit, you should automatically qualify and be able to apply in that way, but you can also get them without getting a qualifying benefit. So again, you apply through the council for that one. The Motability vehicles, you have to be on a qualifying benefit for that, and that's mobility related elements of disability benefits. Refunded travel to hospital appointments, again, there is a scheme that you can apply to for that. And vehicle tax discounts of 50 to 100%, depending on what level of mobility element you receive. And then there's the access to work, which helps with funding of equipment and or services to help disabled persons overcome work-related obstacles resulting from their disability. And finally, these are the contact details for Herefordshire Office. So there's a telephone service, which is open Mondays, Wednesdays and Fridays from 10 till 3. There's a text service, which you can use anytime. And if you can give us a few details as stated on the screen, that is really handy. And then we will call you back as soon as we're able to. There is also an email advice service for initial contact by email, and also providing a phone number so that we can contact you for more information. And if you want to access information yourself, then you can get information and advice from the national website, which contains a huge amount of advice and guidance about all sorts of different subjects, not least of all carer benefits. And that's it. So thank you very much for listening. Do note the benefit rules change and amounts change. So for example, the £20 uplift on universal credit is actually due to come to an end at the end of September this year at the moment. So it's worth being aware of how and where those rules are changing. There's a lot of changes that are directly resulting from coronavirus at the moment. So it is worth taking that into account when you're thinking about accessing benefits or changing particularly benefits. So if you're thinking of changing from an older type benefit to universal credit, then I would suggest that you get fuller information about that, because it does include that £20 uplift, so it could make quite a difference. And that's it. Thank you very much. So are there any questions?
Thank you, Steph. There is one question in the chat, which I will just have a look now, from Suzanne Farmer. If someone is under 25 claiming universal credit and they are awarded LCWRA,
Yeah.
are they entitled to claim over 25 universal credit standard allowance?
Ooh. I'll be honest with you, I don't know that off the top of my head. So I'd need to look that one up and come back to you, which I can do if you like. So that's probably best done via email. So yeah, I can share my email with you to enable you to do that. But that's quite a complicated whammy, that one.
Trust Suzanne to come up with the most controversial one.
That's all right, but yeah, I can't give you the answer to that one now, I'm afraid. Sorry.
I've got another one, Steph, from Kieran. I would like to know, is there any support if you're working full-time, financial support?
Right, that's a very good question. Obviously, you can't claim carer's allowance if you're working full-time. If you qualify for benefits at the moment, you might get some of the bolt-ons because of being a carer, even though you're not entitled to carer's allowance. If you don't claim any benefits at all, then that's highly debatable in terms of because it's all sort of linked into the benefit service, if you like. So yeah, that's going to be unlikely if you're not claiming any benefits at all. Does that sort of make sense?
I'll just wait and see whether Kieran comes back on that one.
Yes. Yes,
sorry,
thank
Kieran?
you. Hi, can you hear me?
Yes.
Yeah, thank you for that. Yeah, I don't receive any benefits at all because me and my husband both work full time. So I was just wondering what financial support really there is available for people that do work full time, because it tends to be that you're never entitled to anything, grants or anything. It just seems like we get penalised because we both work full time, and if we didn't, we'd be entitled to like grants, we'd be entitled to benefits, we'd be entitled to so many different things. So that was my main reason for being here today, really, was just to see what sort of financial support there is if you're working full time and still have those extra costs that are related to a disability.
Probably the best way of going about that is about the benefits that the person who's disabled is entitled to and the exemptions that they might be entitled to. Because yes, with both working full time and not being in the benefit system as a result yourselves, then yeah, that does rule out quite a lot of support. Typically speaking, that support is in place because people are unable to work because of their care responsibilities, although I totally understand that actually some people still manage a full-time job and you could argue full-time and more caring responsibilities. So I absolutely hear you on that one. But I would look at the benefits that the person with disabilities is entitled to and look at it that way.
Okay, thank you very much.
Thanks, Kieran. That was a really good question, because I'm pretty sure that there's lots of people that work full-time and still care, but still have the additional costs of caring for somebody.
Yeah,
So,
I agree. I agree, and it just seems a bit unfair, doesn't it, sometimes? Because I care for my daughter and I care for my sister, for both of them, and they've got like quite complex health conditions, both of them, and I do work full time because, you know, I have a great career and I don't see why I should have to give up both if I can manage. But it's just a little bit unfair sometimes when you think, you know, I could be entitled to things for them or grants, and every time it goes off my income, and it's just how it is, isn't it? But thank you, appreciate that.
That is, yeah, I really would suggest have a look at the people with disabilities as, you know, their qualifying factors, because that's where you might get the extra help. The other thing that, and Suzanne will be able to talk to you more about this, is whether, you know, a carer's assessment or a care, you know, disabled person's needs assessment can help with regards to that.
Yeah, thank you.
Okay.
Thanks, Karen. I've got one more question in the chat from Beth at Eulani. She just wants to know, is Jackie still the Macmillan advisor?
No. So we've got, Vicky and Ruth. They're both very, very good, but yes, I think they both started within the last year, I think, something like that. So yeah.
That's great. Thanks, Steph. Anybody else got any further questions for Steph? Suzanne, you've got your hand up.
That was in relation to Kieran's question about grants. Sorry, Steph. And it was just to say that possibly there may be an occupational charity that might be offer some support and grants to people who are in employment. And if they're supporting family members or people who are dependent on them within the family, that can be an avenue to find some sort of financial support. And specifically quite often with needs or crisis needs, like for example a washing machine breaking down or something like that can happen, and they can be very supportive, and quite often they are looking to support people as well, because not enough people go to them.
In addition to that, Kieran, there is actually the Carers Trust grant of up to £300 that carers can apply for. And that you can apply for that through your local carers association, because I'm assuming from your voice that you're from, is it Manchester?
Yes, I am from Manchester.
yeah. So Carers Trust grants up to £300 you should be able to apply for. And like Suzanne said, some of the charities will also offer sort of small grants for various specific things like respite, laptops, white goods.
Right.
Some even do adaptations to homes as well. So it's worth checking in with your local carers association for that, Karen.
Thank you.
Okay, so I've got no further questions in the chat. Oh, sorry, Julia, carry on.
Hi, sorry, I missed the end of what Suzanne said, but sorry if I'm repeating what she said, but a lot of work-related charities and work-related organisations will also help carers. So I don't know if that helps, Kieran, but I know that having worked for both sides, Carers Trust and for the council, we often directed people to get carers grants, but we also directed them to get work related and apply. And they often ask you for, have you exhausted every option, which you probably have. So they then will be very, very supportive. And military charities as well. If somebody's been in the military ever, they are really helpful.
Okay, thanks, Julia, for that. Okay, so no further questions. So if we hand over to Suzanne. Suzanne, are you ready?
Yes, I am. Thank you very much.
The floor's yours, Suzanne.
Lovely.
If everybody can mute.
Okay, thank you very much. So thank you for inviting me to join you all on Carers Week, where we recognise carers and aim to make caring and carers more visible and valued, as they're so essential. I'm happy to take your questions at any time, as Chrissy said. So, you know, you might want to ask questions just to shut me up, which I'm very welcome to receive. So thank you. So I'm Suzanne Farmer. I work for Herefordshire Council Welfare and Financial Assessment team. And I have an employment history working as a welfare officer for occupational charities. I've been a visiting rent recovery officer. I've worked as a home visiting sales assessor of disability equipment, and now I've come to work for the local authority doing financial assessments. And what I think I bring to that is to, and as a lot of people in our team, is to work with people and recognizing their needs as carers, as people with disability needs, both physical and mental, and the impact that these issues have on families negotiating the care system. And then thrown into that mix is financial assessments as well. So it can be a real emotional time for people when we speak to them when they come into the care system, and then have to start talking about finances when they've got other needs that are perhaps a priority on their mind. So one of the things that's important that we do is we maximize income, and certainly Steph's covered a lot of the points that we look at as well on that. So with the Welfare and Financial Assessment team, it comprises of residential financial assessment officers, domiciliary financial assessment officers, which is the role I do. We've got welfare rights team, which are people, two ladies who take on appeals against the DWP and challenge PIP decisions where PIP's been removed for some reason, and other such challenges, which again is a lengthy process, but you know, vital for people in Herefordshire. We also have our direct payment team that deal with all the direct payments and the work involved around that. And direct payments are another way that people can express their individuality of having their care needs met. So again, very vital work that we do. And then we also have our ladies who arrange our appointments and prioritize our work for us within the team. So financial assessments, unlike NHS care, social care is not a free service, and local authorities are granted powers under the Care Act to charge for the services that they provide based on a means test. And the Care Act is clear that people should pay a fair contribution to the cost of the care and support services they receive. And the financial assessment process under the Care Act is clear, fair, and a person should never have to contribute more than they can afford to towards the cost of the care and their support. Income is always taken into account for the purposes of the charging under the Care Act, but there are some areas of income that's disregarded. For example, earnings are disregarded, some housing relating costs, mobility element of PIP, and the pension credit savings element is also disregarded. If when the services are being provided, they're there to meet a person's identified personal care and support needs. So that's usually done before a financial assessment, and that is the strength-based assessment, which takes into account a person's whole situation, and from that it provides the support plan. And if support services have been identified, any care and support provided by Herefordshire Council is liable to this means tested contribution by the person receiving the help. So the first things we do is we identify income and maximize income. And every financial assessment includes a welfare benefit check to maximize income. This is for our point of view to ensure that central government funding is contributing to the individual's cost of their local care provision, thereby lessening the burden on the council taxpayer in Herefordshire. So that's a big priority, and we work with the Citizens Advice Bureau, with the Universal Credit work that they do, as well as with our welfare benefits to challenge any decisions as well. And as Steph would probably be aware, as we are, so many people don't claim all the benefits they're entitled to, and we're constantly promoting the uptake of benefits as well. At the moment, we are excluding the £20 COVID increase to the benefits, and we have done from the beginning of COVID. We also, as well as Steph, identify areas such as the warm homes discounts and water sure as another capped scheme with the water providers to make sure that people are not spending excessively where they don't need to when they have eligibility for other discounts as well. There is a downside to maximising income. If we do identify that there is an area that a benefit can be claimed and that is not claimed, then we do have the right to treat that income as though it is being received, and the financial assessment will include that income if of any unclaimed welfare benefits, if there is an entitlement to it. So you would be assessed as receiving these entitlements, and your contribution towards your care would increase as though you are receiving those benefits, for example. We work uniquely in Herefordshire with the Department of Work and Pensions, and they provide a visiting, though currently it's only a telephone service, to assist people to claim benefits such as attendance allowance if they have no power of attorney in place to assist them and they're not able to manage to do these claims themselves. It is a limited service. Certainly, it's only a telephone service at the moment, and they take the information by phone and post the forms out. We're hoping that at some point they will return to visiting, because they will do some other work as well whilst they're there. But predominantly, it is for the attendance allowance and pension credit applications, though they will possibly look at some PIP applications when they're visiting if forms are available. And like I say, they work hand in hand with us in Herefordshire. So when we have the financial assessment income figures, we also have to take into account what is the minimum income guarantee. And you might hear that in two formats. With the Department of Work and Pensions, there's a minimum income guarantee with pension credits, but also we have a minimum income guarantee for financial assessments. And this is money that's been, that the government sets, that we have to exclude a person's income, and that's based on their age and the disability benefits they receive. So an 18-year-old's minimum income guarantee would be a lot lower than an older person's minimum income guarantee. For example, someone of pension age, that is currently £194.50 a week of their income that's disregarded for financial assessments. So, and that then allows them to make their personal choices regarding meeting some of the costs of their individual needs. Then we also look at disability related expenditures. Is life more expensive because of your disability or illness? Some of the things that you might have to purchase or services that you may need to have are slightly more than somebody that has no disability or illness. So throughout the financial assessment, we would then go through some of these outgoings that you might have, anything from specialist food, possibly, domestic services, gardening services, this type of expenditure that we would need to see itemized. Obviously, we have to see everything verified, and we have to make sure that they are reasonable expenses. For an example of that might be you live in a 6-bedroom property, and we wouldn't class it reasonable for a cleaner to come in and clean every room of that property as a full spring clean and then expect those costs to be within the financial assessment, because that wouldn't be deemed as reasonable, as an example. And it may be that you're having to maintain or purchase specialist equipment such as wheelchairs, stair lifts, hoists, where they have to be regularly maintained. There's repairs to them. There may be insurances for them. And these are in a cost that we can include as a disability related expenditure. And we would just need evidence of invoices or the items showing on bank statements or receipts, just to show that this expenditure has been spent. If, for example, a family member has decided to treat you to a stair lift and it's a gift and you've not paid for it, we can't include that within the financial assessment. And that's just because we have a duty to the council taxpayers in Herefordshire to make sure that we do protect the public purse. So this is why some of our assessments are lengthy, because we give you every opportunity to provide all this information, to have all the discussions about your expenditures, which can be very individual to each person's needs. And we can have two people with a similar condition, but their contribution when calculated can be very different. And it can just be down to the fact that one person would be paying contents insurance for where they're living and somebody doesn't, which we can take into account as a disability related expenditure. So our appointments, this is why we make our appointments. We allow plenty of time for them and to allow people to ask lots of questions and have an understanding of the assessment as we go through. Some people decide they don't want a financial assessment and the thought terrifies them. We always suggest to have the financial assessment because it may be that it would be cheaper for somebody to do that than to refuse one, where you would then be charged the full cost of the services that you are being offered by adult social care. And in addition to that, you would be we charge £100 setup fee for putting those services in place and £9.50 for the invoices that we send for weekly. So it may be just having the financial assessment. It could be your contribution is far less than the amount of the services that you would have to pay. But the option is there and no one is going to force you to do it. Sometimes we get asked if a wife, for example, is having services and her husband might want to know if his income needs to be disclosed. And that can depend on the wife's income, and it may be that a couple's adjustment can be looked at. If there's a possibility that that might reduce the wife's contribution, and we can look to do that and have that discussion with people as well. So what if you think you're being charged too much? Most people think they're being charged too much because a lot of people think that they should not be paying for care. Unfortunately, under the Care Act, that's not the case. But if you think you've been charged too much, you can ask for a review. Come back to us and ask for a review, and we will go through the financial assessment with you again to review it. And if you still feel dissatisfied, then you do have the right to an appeal. And then we can talk you through that as well. And another area that comes up is where somebody feels that they have the right to give and gift their capital away to avoid making a financial contribution to their care and support services. Deprivation of assets, capital and income. And this means you've intentionally decreased your assets in order to reduce the amount that you contribute towards the cost of the care services. The Care Act is clear on this. It's not acceptable. And the local authority or ourselves will look into this. And if it is identified that this has been the case, you would be treated as still having that capital income or assets. And we do have the power to take steps under the Act to recover lost income from the person or third party the asset or income has been transferred to. Failure to provide any information in the financial assessments will result in you being deemed as self-funding, as we do have to evidence information that's given as a financial assessment. It is an agreement that we enter into, and we do have to verify the information that you provide to us. Normally, without COVID, we would do this through home visits, and we're working with families, power of attorneys, and our clients to have this information sent in by post at the moment and by email, and we are looking to the future to do other ways to make it easier for people to send us all this information. And we are flexible. We're not demanding that it's produced immediately. We are giving people a chance to do this, as we appreciate people working with us through COVID and the difficult times that that we have at the moment. Just to cover some other areas, Herefordshire Local Authority, we negotiate the fixed rate contracts with the care providers. So to have the care through ourselves, even if you're self-funding, can be cost effective because we do have the local authority rates. And as you know, care providers with private rates, they can vary on the open market for their care services. They can include travel costs, mileage costs for some service users. In Herefordshire, it's a very rural area, as we all know, and these purchases can be quite costly for people. So it's always worth coming to the local authority for the assessment and to see what can be provided, or to look at whether a direct payment might be an option for people as well. So it's important to report all changes of income and disability related expenditures to ourselves to make sure your financial assessment is fully up to date. If you're awarded a benefit, or the person you care for is awarded a benefit and it's not reported to us, at some point we will find out and we will backdate. So it is important that you keep us up to date. You know, it is in part of the agreement that you agree and to when you enter into the financial assessment with us. The biggest problems we get are where people have an income change, they don't tell us, and then we have a backdated calculation on money they owe us, and it can cause upsets. And this can be avoided if you just report anything to us that changes. And you know, you can do that by email or telephone. All our letters are sent out regularly with all our contact details on. Please keep in touch with us. We would much rather that we hear more from you and get this information than not. So please do that. And we advise, I know Richard is going to be covering this, but we advise at every financial assessment and every opportunity where we talk to service providers, to service users, seek independent financial and legal advice. And we signpost, we do a handout that we give to everybody at every opportunity where they can get independent and legal advice, where to find regulated and non-regulated advice, and how to apply for power of attorney. And you know, again, we encourage people to take this up and to get this information and advice as early as possible to allow for their financial planning. And I know that Richard's going to be covering this in detail. So thank you very much. I'm sorry if I've gone on a little bit too long, but I'm welcome to take any questions.
Thank you, Suzanne. That was really good. That was really informative. Do we have any questions from anybody for Suzanne on that? Wow, you've silenced everybody, Suzanne.
Yes. I'll send the links to Chrissy for where you can get all our leaflets on our website. We've got a wealth of information on our website that's available to everybody for our financial assessments. And also include my contact details in case you want to come back to me with any individual questions relating to specific service users as well.
That's great, Suzanne. Thank you. You've been a help to me in the past for lots of different clients. So it's always good to have your contact details.
Thank you. And you've been a help to me when we've struggled to get information from people. Having somebody like yourself that can go in and in a gentle way get the information we need, it is so valuable. And again, thank you for that. It's brilliant.
It's a pleasure. You're very welcome. Okay, are we all okay to carry on? Everybody okay? Thumbs up? Yeah. Okay, it's Richard. Down to you. You can share your screen.
Thanks, Chrissy. Fingers crossed this should work. So I'll hold my breath and hopefully away we go. So just to introduce myself, my name is Richard Green. I'm a partner at Just Wills and Legal Services, and I've been an estate planner now for last 19 years now. So I don't know quite where that time has gone. Let's just close that down a little bit. Hopefully this will move out of the way. Okay, So just go back to the beginning. So I've been asked to talk to everyone today about managing someone's affairs. I think the key really to doing that is to plan for the future, and that takes a lot of different aspects. So I think the key thing really is to plan ahead, and hopefully today's talk and presentation will give you a few ideas of the things that perhaps need to be concentrated on. So typically an estate plan, or a thorough estate plan, will have several key elements. There'll be a will, obviously to take effect if somebody passes away. There will be lasting powers of attorney that will be there in case somebody has an accident or illness during which they lose capacity. Trusts can be used for loads of different reasons, for protecting assets, for ensuring what happens in the future. And financial planning is obviously an integral part of planning for the future, but that's not something we'll cover today. So the aim really today is to give as much sort of general information as possible. But if anyone's got any questions, please do ask at the end. The additional bits showing at the top of the screen, Chrissy. Hopefully that will disappear. Just bear with me 1 second. No, I can't seem to get rid of that. But
what is it you want to get rid of, Richard?
Is there this extra bit sort of menu bar at the top of that you can see on your screen?
No.
No, that's fine. All right, so it's probably just this, and that's fine. So a well-prepared estate plan will make life easier for yourself, but also it will protect you and your family. So some of the key areas of concern for clients and for family members are obviously a loss of capacity. That's where the power of attorney kicks in, and we'll cover that in more detail. In the event of a death, obviously the will takes effect, so any provisions that you put in place there can help your next of kin to deal with your wishes. One that's often overlooked are funeral wishes, and again, we'll talk about that in more detail. But other areas of concern are things like making sure assets pass down to children or to loved ones. And there are often things that can be done to give some more certainty to that and some longer term planning. So all of these kind of things, bloodline planning, worries about death and remarriage, or divorce, bankruptcy, things like care costs, inheritance tax, all of these things are concerns for clients. But obviously, as carers, one of our key concerns is safeguarding vulnerable and disabled beneficiaries. And as a parent carer myself, that is something that's very important to me. And I see a lot of clients that need that advice and support to make the right choices. So something that's often overlooked is, in fact, what there is and where it is. You can imagine if you lost capacity, all of a sudden there was no planning, no forewarning of that happening. One of the key things that is often overlooked is what there is and where it is. So would your loved ones or your executors know what you own, how many bank accounts you've got, where they are, what savings, investments there are? Lots of things have gone online now, so you don't get bank statements dropping through the door on a regular basis. And I think that's something that is absolutely key. It's having some way of communicating that to next of kin. Executors and attorneys aren't necessarily going to be loved ones, family members. They could be friends. They could potentially be professionals as well. So having some kind of reference point is very, very important. It can be things about your home, for example, utilities, mortgages, loans, insurances. But also in this day and age, digital assets are becoming a much bigger entity. It's not just the online bank accounts. Life insurance, quite often they're now moving across to online portals that you can have a look at your documents. The same with car insurance and life insurance. And also, would your executors know if you've got a funeral plan or not? That's something that's, that can be overlooked. Sometimes next of kin will appoint a funeral director, go direct to them, and then subsequently, a bit further down the line, we find out that there's a prepaid funeral plan already there. So having some kind of reference point that your executors or attorneys or next of kin can look at and reference is very important. Just over my shoulder, I've got a yellow file that's it's titled "In Case of Emergency," and it's got everything in there, or majority of things in there that executors or attorneys would need, or my wife if something happened to me. It's got a list of what bank accounts there are, whose names they're in, just basic reference details for as much as possible. What it really does is to make life easier for loved ones at what would be a very difficult time. Quite often, people will obviously not be able to access things like laptops. Sometimes that it could be, things that important documents are saved on there, but it also could be things like photographs, which can be very important to people that, if they lose a loved one and suddenly they can't access all this digital information, that's again something for people to really sort of consider as a part of the process. So the importance of making a will. The will is obviously an important part of any estate plan, but it's still estimated that over around 54% of adults don't have a will. It's probably higher than that in real terms. But if you don't make a will, you die intestate, and basically the government decides who your beneficiaries will be. So through the will, you can appoint people that you trust, people that are well suited to key roles. And that can be the executors, the people that sort out your estate if you die. Trustees, so they're people that look after money and trust assets over a longer period. And obviously guardians for children under the age of 18. Making gifts and distributing assets is obviously a focal point of the will, but sometimes it's the smaller gifts, it's the personal effects, the things that really mean something to individuals that they want to go to. Perhaps people outside of the immediate family, might be a next door neighbour who's helped for the last 10 years get them shopping, or cutting the grass, or all these kind of things can be very meaningful to people. So it's not always the big things in the will. Sometimes it's the smaller things that people want to focus on. Dealing with your estate tax effectively. We'll talk about inheritance tax just as a brief overview in a little while, but that's an integral part of the estate planning as well. And protecting assets for all sorts of different reasons through the use of trust, through trusts. Obviously, you can communicate funeral wishes as well through the will. So if you do have any specific wishes, it's really important to communicate that to next of kin or to your executors. Funeral wishes in the will are generally quite straightforward. It's often things like burial or cremation, and perhaps if ashes are to be scattered or buried, sometimes where that's going to take place. But more detail can be added with letters of wishes that can be stored with the will. And the option obviously is there to put a funeral plan in place as well. I think it's general population, I think around about 11% of people, were saying that they've actually prepaid for their funerals. So that figure is gradually going up over the years. If you do have a will, one of the key things is it's out of date, or is it not being drafted correctly. A proportion of wills contain errors and mistakes, or they are out of date. Legislation changed over the years. There have been a couple of changes in inheritance tax legislation over the last 14 years, some quite big changes. So it's important to keep your will reviewed and up to date. Sometimes very small errors can make a significant difference. So we quite often see this with DIY wills, where people are making gifts and that kind of thing. Just a simple change of word can have a significant impact. So for example, if you wrote in your will, I give my Rolex watch to my brother, you subsequently die. If you don't have a Rolex watch, then there's nothing to give to your brother. If you say in your will, I give a Rolex watch to my brother, then your executors have to go out and buy a Rolex watch from your estate and give it to your brother. So very small change in wording can have a significant impact. So it's always best to take professional advice and make sure things are done properly. So one of the things that perhaps is overlooked is that wills can be changed after somebody's passed away. So if there are any tax implications in terms of inheritance tax and things like that, then it has to be done within 2 years of the death. Otherwise, potentially it can still happen after that 2-year period. And that's done using something called a deed of variation. It can't be done if there are children, minors involved, but under certain circumstances, it can be a very effective estate planning tool. So just touching on funeral arrangements in a little bit more detail. Funerals, it's the first payment that will come from the estate, and prices, the cost of basic funerals have increased very significantly over the years. It's gone up 128% since 2000, well, between 2004 and 2019. And the average cost is just under £4,200. So basic cost of a funeral includes fees for cremation or burial, a doctor's fee, a funeral director, and a minister or a celebrant. Obviously, funerals can cost a lot more than that. A headstone can cost over £1,000, so there's lots of potential additional costs involved as well. But I think for some people, it's quite a shock. If it's something that's not been, there's no provision made for it, it can be quite a surprise for next of kin. In 2020, it's estimated less than 1% of people knew all of their loved ones' funeral wishes, and 17% didn't know anything at all. So that 17%, they wouldn't even know if it was a burial or cremation. And over the years, I've spoken to so many clients, and quite elderly clients as well, that have said, "Oh, I thought you wanted this," or, and they've just never had that conversation. So letting your next of kin know, letting your executors know or having it written down is really important. I find that, obviously at a very difficult time, it can be a source of a real sort of contention. So if one family member wants one thing, one wants another, it can cause all sorts of upsets and disagreements. Inheritance tax, it's the unintended beneficiary. It does very well from people's wills. So inheritance tax, it's one-off payments on your assets and possessions above the threshold, which is currently £325,000. Tax is set at 40% of any value over the threshold. But if you're married, you can actually transfer the allowance from the first partner to the survivor, and that's if you're married or in a civil partnership. So as a married couple or civil partners, you've basically got £650 free of inheritance tax. Budget changes in 2017. It's quite a tricky one. We could spend an hour or two actually talking about this. So all I'm intending to do really today is to make you aware of general things and just looking at things on quite a basic level. But there is an additional allowance now where you've got property, where you own property and you've lived in that property. It's called the residential mill rate band, and it's an inheritance tax allowance worth £175,000 per person currently. That can be used where you're passing property or the value of property down to your children or direct descendants. Inheritance tax last year was over 5 billion over the 12 months, so it's quite a chunk of change. So it's something that can be mitigated through sort of estate planning. Sometimes by using trusts, you can skip generations. So if your children are doing very well for themselves, you might not want to pass your assets into their estate, which will make their inheritance tax situation worse. So sometimes generation skipping can reduce the long-term effect of inheritance tax. Trusts are something that's, again, can be talked about for many, many hours. They can get quite complicated, but we're looking again at this at a very basic level. Trusts can run for 125 years. This is change in legislation that happened a few years ago. Previously, it was for 80 years. And it's the perpetuity period, it's called, and it's basically there to stop money being taken out of the economy for an indefinite period. But obviously 125 years, a trust can run through several generations. So you can either set up a trust during your lifetime, or you can put it into a will, and then when you pass away, it will then be put in force at that time. Trust can be flexible. Things like a discretionary trust can be used for all sorts of different purposes. It could be used to protect against things like divorce. Perhaps if one of your children is in an unstable relationship and you're worried about passing money into their estate, a discretionary trust is a very effective tool, because they can benefit from the trust, but they won't actually own the assets. They can only hope to benefit from it. A vulnerable person's trust or disabled person's trust is a form of discretionary trust, but it's got certain tax benefits. And if the person qualifies, as we've talked about previously, for a certain qualifying criteria in terms of benefits, then that would be a good way to protect assets for that beneficiary. And with those types of trusts, you can nominate a principal beneficiary as well. So you can name that person that you want to be the main beneficiary of the trust. The key thing is it allows provision for them, but it won't affect their benefits and income. So that's very useful for a lot of situations like that. There are things like fixed trusts, which are life interests. So what you can say is that if I was to pass away, my share of the estate is to pass to my wife. She can have a life interest in it. She can have a right to live in property and right to any income. But when I die, when she then dies, then the benefit will pass on to the children. So it's a way of guaranteeing what happens. You've got a lifetime beneficiary, and then you've got capital beneficiaries at the end of the trust. There are also things like hybrid trusts. So you can combine the two. You can have a life interest, so you can guarantee that the surviving partner has a life interest for the rest of their lifetime. But when they die, the trust then becomes discretionary. It becomes very flexible. And that can be used as a family trust. It can run for, as I said previously, for 125 years. So it can benefit children, it can benefit grandchildren and future generations down the family line. And in these kind of situations, sometimes it's beneficial to make loans to beneficiaries rather than actually giving the money outright. So there's quite a bit of flexibility in there. And children's trusts, quite a simple trust. A lot of people would be concerned about leaving a significant amount of money to children at the age of 18. I think probably as 18-year-olds, we weren't the most savvy when it came to money. So perhaps putting a children's trust in place, giving the ability to keep that money safe for your children up until the age of 25 potentially, it can make a huge difference to that. So I'll just give a couple of examples of how trust can benefit. A typical family, Peter and Sandra are a married couple with 2 children. So remarriage is a concern for a lot of clients. Sideways disinheritance, it's called, where assets pass sideways, they don't pass down to your children. So in this situation, after Sandra passed away, Peter inherited the house and assets set out in Sandra's will. Peter gets lonely and decides that he needs someone new in his life. He remarries. Sometimes after that, he dies, leaving everything to his new wife. She then changes her will, leaves everything to her children, and then Peter and Sandra's children receive 0 inheritance. It's called sideways inheritance, as I say, and it's where assets pass out of the bloodline, pass to other families. Obviously, Suzanne was talking about care costs, which is something that is on the mind of a lot of people. Key thing, as Suzanne was saying, deliberate deprivation of assets is an absolute no-no. But what you can do in terms of protecting assets when first partner dies you can potentially safeguard their share of the estate, benefit the surviving partner, but still leave something in the fullness of time for children or for other beneficiaries. So in this situation, Peter and Sandra were married with 2 children. When Peter passed away, his assets were inherited by Sandra. Some years later, Sandra went into care, and the equity in the home and other assets were used to fund the care costs. As a consequence, Peter and Sandra's children received little inheritance. So Sandra was still, if we were to put planning in place, if we were to use different trusts, Sandra could still be a beneficiary of the trust. She could still receive income and all those kind of things. So she wouldn't lose out. But what it would do would be to safeguard something long term for the children. So possibly a half share of the property and things like that. Just before we go on to the power of attorneys, as the last bit, I think one of the key things really in any estate plan is to understand everybody's situation is different. You know, it's a case of sitting down, talking through the situation, what's important to clients, and then it's a case of really looking at what the priorities are, whether it's keeping everything very basic and simple at the outset, or if there are certain key concerns that clients have, then it's just about sort of working ways of making sure that those concerns are dealt with. Power of attorneys. So with loss of capacity, this is where the power of attorney kicks in. In 2019, there were over 850,000 people living with dementia in the UK. It's a staggering number, and it's set to keep increasing over the coming years. It represents 1 in 14 of the population aged 65 years and over. The figures come from the Alzheimer's Society. So if you lose capacity, there's often an assumption that next of kin can walk into the bank and take over, deal with assets, deal with your money. But unfortunately, that's not the case. If you're a married couple, if you walk in and say, could I take £5,000 from my wife's account, please? The bank will simply say no. And it's the same if you lose capacity. Your accounts will be frozen. There won't be any access to information. Things like investments will also be frozen. So if you don't have a power of attorney already, loved ones have to go through the court of protection. And during the period of the application, the assets are frozen. So a power of attorney is a vital part of the estate plan. The lasting powers of attorney were introduced in October 2007. This followed the Mental Capacity Act of 2005. Before that, there was only an enduring power of attorney which dealt with financial affairs. They're still valid as long as they're signed and witnessed correctly before October 2007. We do come across them still from time to time. We also come across ones that weren't filled in correctly as well. So it's always worth, if you've got provisions in place, making sure they are right, get them checked, and just make sure everything's in order. So the government now assume that if you're over 18 years of age, you can make your own decisions. And if you can't because of accident or illness, then there's nobody else that can actually step in and assume responsibility for your affairs. Obviously, in terms of some of the benefits and those kind of things, you can have an appointee. So that is separate to the power of attorney. But as a wider sort of benefit, the power of attorney is a key part of planning. So, as I say previously, the alternative is court of protection deputyship. If you don't have a power of attorney for property and finance and you lose capacity, the process was previously taking around about 6 months. It's currently, due to COVID, it's taking around about 9 to 12 months. And it can be an expensive process. There can be all sorts of different costs involved in that process. There can be medical fees, there can be court fees. There are also checks that are done on each of the deputies that are seeking to be appointed. And even after that, there are also ongoing fees that deputies have to pay from the donor's estate. So the power of attorney, it's there as a backup, but it shouldn't be a first choice for the majority of clients. A few years back, I had a client that spent nearly £5,000 trying to get the deputyship through the court of protection. I think that was, there were quite lots of medical fees involved in that, but also legal fees and support as well. So it's not the ideal way to move forward. Also, with the cause of protection, you haven't got the control over who's going to look after your affairs. So if you've got, family disputes and these kind of things, sometimes they can be quite problematic. So, and it might not be the right person that will be doing that job. So, lasting powers of attorney, there are two types. There's property and financial affairs, and this is probably the one that most people are familiar with. What it does do, if you lose capacity or if you need assistance while you've still got capacity, then it enables people that you choose to be able to deal with your financial affairs. So that is anything from paying the bills, doing all the day-to-day bits and pieces, right through to managing savings and investments and potentially buying and selling property on your behalf. So it's a powerful document, and appointing the right people to take on that role is absolutely key. Health and welfare, this really does what it says on the tin. It appoints people that you trust to make decisions for you if you can't do that for yourself in the future. So this can be things like medical treatments, what kind of care you receive and where you receive it. And also you can elect for your attorneys to make decisions about life-sustaining treatment if you can't do that for yourself. So life-sustaining treatment can be any form of support that's needed from doctors to keep you alive. So it can be something like a major operation or course of treatment, right through to something as simple as a course of antibiotics in case of things like pneumonia. Both power of attorneys are a very important part of the plan. So sometimes people opt for one or the other, but it's really important to have both there. Once they have been drafted, they have to be registered before they can be used, which is a key part of the process. But they do offer more protection for the donor, for the person that's given the power of attorney, than the old enduring power of attorney. Previously, an enduring power of attorney could be drafted, it could be signed and witnessed, and that person could then go off and manage somebody's affairs. So it was open to quite a lot of abuse, and it wasn't the best way, really. So the attorney, it's often a spouse or one of the children, but you can appoint siblings or close friends. It's people that you trust and people that are suitable to take on that role, basically. It doesn't cost more to name more than 1, 2 or 3 attorneys. It makes no difference at all. If you lose capacity, then your appointed attorneys can manage your affairs in line with your wishes and only for your benefit. So that's the key thing. They have to act in your best interest at all times. And you can have attorneys either act on their own, so solely, or they can be appointed jointly. Jointly can be restrictive because it means that all attorneys have to agree to everything, sign everything, and it can be quite problematic. So if somebody's poorly, if they're unwell, or if they lose capacity, then that appointment can fail potentially. So we always recommend, if you've got more than one attorney, that they can act jointly and severally, which means that they can each act on their own. The key thing to that is if one's poorly, if somebody's abroad on holiday or anything like this, then the other person can keep things ticking over. But usually, if there are significant decisions that need to be made, then all attorneys will be consulted before those decisions actually take place. So once the documents have been drafted, they've been signed, and everything else is part of the process, documents have to be registered with the Office of the Public Guardian, which is a government department. It usually takes about 12 weeks, but currently with all the delays and things with COVID, it's taking on average probably around about 15 weeks. So it's not a quick process. It's obviously significantly quicker than going through the cause of protection, but one of the key things to take away from this is plan ahead, plan why you're fit and healthy, plan why there's no issues. So often clients leave it too late. I've seen a lot of people over the years where dementia has been an issue, and I think quite often people will, they don't recognise that point at which capacity has gone too far. Capacity is a complex area, so It is possible, obviously, to put a power of attorney in, even in the early stages, if somebody's got the early stage of dementia. But it's important not to leave it too late. So thank you for listening. I know it's been a lot of information on a lot of different subjects, and I hope that really the sort of takeaway from today is that an estate plan is quite broad ranging. It's the power of attorneys, it's the wills, but it's also the other parts of it. It's the information side of things as well. If anyone's got any questions or would like to contact me separately, if you've got any specific questions or queries, please do feel free, and I'll be happy to try and answer any questions that anyone's got at the moment.
Thank you, Richard. That was absolutely fantastic. I have got a couple of questions in the chat, and I know I can see Mark has got a question as well. So
Of
if I
course.
just start with, I've got a question from Suzanne Farmer. If an unregistered EPOA has been made in the past, will this now need to be scrapped for a lasting power of attorney?
Okay, so an enduring power of attorney didn't used to have to be registered unless somebody lost capacity or was losing capacity. So it depends really on individual situations, to be honest. Power of attorneys are still applicable. They still, so long as they're signed and witnessed correctly, that's the key thing. Before the 1st of October 2007, then they can still be used. Quite often when I sit down with clients and we review them, things have changed, or they want to put in a bit more flexibility. They want to put in additional levels of attorneys and things like that, which it wasn't available previously. A power of attorney, you could basically just appoint one level of attorneys. But with a power of attorney, you can have first choice, you can have more than one first choice, you can have backup attorneys as well. So there's more flexibility, but the old enduring power of attorney, it still has its place as long as it's correctly signed and witnessed. It doesn't necessarily need to be scrapped, but it's not something that can be registered in advance as well. So it's basically has to be registered if somebody loses capacity at that point, in which case there might be a delay before they can be used. So quite often people do move across to the lasting power of attorney, but happy to look at that on a case-by-case basis.
Okay, I've got another question from Julia. Can partners set up trusts in a will?
Yeah, absolutely. Anyone can set up a trust in the will. One of the key things really with partners is that they don't have the same benefits as a married couple or couples in a civil partnership. So from an inheritance tax point of view, so there may be certain types of trust which are better suited to unmarried couples. But again, it's sort of looking at it really on a case-by-case basis. Some kinds of trusts, for example, disabled trusts or vulnerable persons trusts, that's absolutely fine in anybody's will. There's no problem there. But if you're looking at things like life interests, that can have inheritance tax implications. So it's looking again specifically on a case-by-case basis.
Beth's had to go, but she said it was really interesting and helpful, and she will direct people towards the website to access the recordings. That's great. Julia also mentioned it might be important to mention that capacity is always assessed each time. It's subject and time specific, so someone may have capacity for some decisions but not others.
Yeah,
Good point,
absolutely.
Julia.
Yeah, capacity is a very complex area, and it can vary at different times of the day, and as Julia was saying, it can also be dependent on different decisions. So in some cases, people will have a capacity to put a power of attorney in place. They may not have the capacity to put a will in place, because they are different decisions that need to be made and different information needs to be retained. So if capacity is an issue, sometimes it will need a formal assessment done, by a professional to ascertain that really.
Steph has also mentioned, If someone has lost capacity and only has a finance lasting power of attorney, what would you recommend?
Okay, in terms of the sort of health side of things, really that's only something that can be put in place while somebody's got capacity. Court of protection can be, you can go to court of protection for certain welfare matters, but it's unusual for them to grant a welfare deputyship. It's much less common than the financial side of things. So in a lot of cases, care providers and everybody else will still speak to next of kin in relation to loved ones. But actually the welfare side of things is something, unless it's put in place in advance, it's very difficult to actually put that in after someone's lost capacity.
I've just had another comment from Suzanne. For financial assessments, we will need to have sight of any trust documents protecting capital and assets and the lasting power of attorney or Office of Public Guardian registration number for lasting power of attorney.
Okay, no, that's good. It's always useful to sort of cross over with other organisations and understand from their point of view what's needed. So that's good.
Now I think we've got a question from Mark. Mark, if you'd like to ask Richard your question.
There we go. Yeah, my question is, I've got the LPA back for my wife, but it refers to an activation code that has a 12-month lifespan. We're not intending to activate or enact the LPA in 12 months unless circumstances change.
Yeah.
Do we need to activate it now?
No, not necessarily. I mean, once the document has been registered, so the activation code is quite a recent addition, and basically the reason for doing that, I think, is sort of during the obviously pandemic, actually sending physical copies of documents and people handling lots of paper copies and things like that has not been a preferred option. So the activation code was a way of financial institutions being made aware of the existence of the lasting power of attorney. If the code expires, the actual lasting power of attorney obviously will still be there. It will be registered and it will be ready to go. But it will probably just be a case that instead of giving financial institutions an activation code, then basically you'll just need to give them sight of the document or a certified copy of it. So, if it's not needed now, there's no reason to enact it this time. The best thing, is to have it actually registered and ready to go. So if it's needed at any point in the future, then it can be used.
Thank you very much.
That's a pleasure.
That's brilliant. Thank you. Anybody else got any questions for Richard or anybody else at this point? No. And I'm just checking the chat. There's nothing else in the chat. I don't know about anybody else, but I found that really, really informative. And even though I've listened to people's presentations before, I've learned an awful lot today. And I do actually have one question. If a will is made, but it was made, say, a few years ago, and there are additions to the family that new gifts or interests are wanted to be presented to them, can you change the will to encompass that?
Yeah, so as an organisation, so I'm a part of Just Wills and Legal Services, which is a national estate planning organisation. But as a company, we don't write codicils. So basically, a codicil is an additional document to the will. So you still keep the original document, you produce a codicil, and then you refer to the original will in that codicil. The problem that we find over the years, I'm dealing with a client at the moment who wants to make a codicil to the codicil to the original will. And the advice to him is just to rewrite the will, bring everything back up to speed. And that's what we do as a part of our process. Because codicils can get lost, they can get separated from the original will. Sometimes it's not clear if they've been lost or if they've been destroyed on purpose. So having the original will and knowing where that's stored is the safest way forward, really.
Okay, thank you, Richard. That's really helpful. Thank you. So no further questions. All I'd like to do is just thank the presenters for today's presentations. It was great, really informative, and you've all done absolutely wonderfully. Thank you very much for helping out in Carers Week. I'm really grateful to you all. And no doubt I will be sending you emails in the future for lots of other things.
Thank you for the invitation, Chrissy. It's been very good to be part of this.
Yeah, thanks very much, Chrissy.
Yes, thank you
You're
very much,
very
Chrissy.
welcome.
It's been really useful, and I've really enjoyed listening to Richard and Steph too, and their information, and seeing Steph as well.
Yeah, now hang on, you've got me at a distinct disadvantage here.
I can't even
Okay.
get clear close and it won't work.
I'm gonna stop recording now.